You ever have one of those weeks where you just can't figure out what's going on? Well, that was the global market last week. On one hand, we saw a massive relief rally, just pure celebration. And then, almost overnight, a sharp, fearful correction. It was a week of total whiplash, and in this explainer, we're going to decode what these mixed signals really mean.
So, what gives? Was this a genuine relief rally, or was it a harsh reality check? We got conflicting clues from the US, from China, and from Europe. It's a real puzzle, and right now we're about to put all those pieces together.
And look, these aren't just some abstract global headlines. This stuff connects directly to the markets and, when it comes right down to it, to your money. So let's break down this week of financial contradictions.
All right, first stop, the United States. And wow, this was a perfect high-speed example of the market's mood swings. We saw a flip from pure euphoria to some pretty deep-seated fear in just a matter of days.
It all kicked off with this number, 43 days. That's how long the US government was shut down, a new record. And that kind of political gridlock, well, it had investors pretty on edge. The huge news that started the week, it was finally over.
And just look at how fast this all happened. I mean, it's wild. November 10th, news breaks that a deal is on the way. Markets surge. 2 days later, it's official. But then, bam, the very next day, the mood completely flips and the market takes a dive. So what on earth happened?
Okay, so first, let's talk about that initial good feeling, that euphoria. Because this wasn't just a US thing, not at all. This was a global party. You had US indexes jumping, especially tech and AI stocks. Europe's stock 600 was knocking on the door of an all-time high. And Asia got in on the action too. It really felt like the entire financial world just breathed a collective sigh of relief. But here's where it gets really interesting. It wasn't just stocks. Another asset was making a huge move, gold. Futures broke through and stabilized above the key $4,000 an ounce level. Now that's a major signal. But wait a minute. Why would a safe haven asset like gold rally at the exact same time as stocks? Kind of weird, right?
So here's the logic behind that. It's actually a two-part story. On one hand, the market saw the end of the shutdown as a green light for the Fed to potentially cut interest rates. That's good for stocks, and it's also good for gold. But at the same time, you've got this bigger, lingering worry about long-term US debt, and that makes gold look really attractive as a safe place to park money. So for gold, it was kind of the best of both worlds.
Yeah, but as we saw in that timeline, this party did not last long at all. I mean, really short-lived. All that optimism just, poof, disappeared almost overnight.
And here's why. It's like the market has a one-track mind. The good news about the government reopening got priced in like instantly. And then, snap, the focus immediately shifted to a much scarier question. Okay, great, the government's open, but is the economy itself actually slowing down? And that fear, that is what sent the Dow tumbling over 800 points. Political relief gave way to economic reality.
Okay, so now let's hop over to China. They are walking their own very delicate tightrope right now. They're trying to support their economy, but without opening the floodgates of stimulus money, all while this huge property crisis with global implications is unfolding.
And this is the official line from their central bank. They're going to, quote, implement a moderately loose monetary policy. Now, listen to that language, moderately loose. It's so careful. They're saying, yeah, we'll help, but they're absolutely not saying they're bringing out the big bazookas like they have in the past.
But that moderate approach is running into some pretty harsh numbers on the ground. I mean, just look at this. Real estate investment, down almost 15%. New home prices are falling at their fastest pace in a year. That property sector is just a huge anchor dragging on their economy right now.
So what's Beijing's plan for dealing with this? Well, we can see it in action with this case study, the giant developer Country Garden and its massive debt restructuring. This isn't just about one company. This is a huge test case for the entire industry.
So check this out. This chart shows you exactly who wins and who loses in this $13 billion deal. The people who owned the company before, their slice of the pie shrinks from over half to just 20%. And the creditors, the ones who were owed money, well, they're basically becoming the new owners. They're swapping debt for a piece of the company. The message couldn't be clearer. The original shareholders are taking the hit.
So what's the signal Beijing is sending with all this? It's pretty direct. Number one, no giant government bailouts. Their goal is what they call orderly deleveraging, basically trying to carefully unwind this debt bomb without a total collapse. The original investors are feeling the pain, and the creditors get a stake in what's left.
Make no mistake, this is a market-based solution, not a state rescue.
All right, for our last story, let's jump over to Europe, where it feels like a very nervous celebration. You know, they're enjoying these record market highs, riding that US wave, but at the same time, they're looking over their shoulder, really worried about what's coming next.
And this slide really shows you that split personality. On one side, you have the party, which is happening right now. The stock 600 is hitting all-time highs, financials are rallying, they're just enjoying the good vibes from the US. But then you look at the other side, the hangover. Their own growth forecasts are getting slashed, there's a lot of fear about new US trade tariffs, and the political scene is, well, uncertain. It's a classic case of partying today but dreading tomorrow.
And that really gets to the heart of the issue. Europe's export-driven economies are incredibly sensitive to global trade. So the threat of renewed American protectionism, well, it casts this huge dark cloud over their future growth. It makes that current market rally feel like it's built on pretty shaky ground.
Okay, so we've seen the whiplash in the US, China's tightrope walk, and Europe's nervous party. So what are we supposed to do with all this information? Let's pull it all together and build a little playbook for navigating this global tug of war.
You know, if you had to boil this entire week down to one single idea, this quote absolutely nails it. Asset prices are literally being torn between good news sentiment and growth reality. It's a battle between how people feel in the moment and what the numbers are actually saying about the future.
So what's your next move? The way to think about it is a two-part strategy. You've got to play defense and you've got to play offense. For defend, think about what protects you from all this volatility we just saw. Assets like gold or high-quality bonds make a lot of sense. And for attack, it's about being smart. Look for real value in stable companies that actually have strong cash flow, not just the ones with a flashy story.
And just as important is what you should probably be cautious of. Based on everything we've just walked through, maybe don't go chasing those super expensive story stocks that got hit hard in the US. It's probably not a great time to gamble on a big rebound for those heavily indebted Chinese property developers. And you might want to think twice about having too much exposure to European manufacturers who are really vulnerable to trade disputes.
So this leaves us with the final, big question for you. In this massive market tug-of-war between sentiment and reality, between rallies and corrections, where are you going to stand? That's really the key takeaway from this wild week of contradictions.